Okay, in this part, I'm going to keep introducing accounts receivable recognition. We know the definition of receivable is claims held against the customer for money, goods, or services, mostly on money. So it represents a cash flow in the future. Okay, so here this is the date of sales, but the cash received in the future, because this represents the lag between the sales and the cash receipts. And we learned in chapter 6 about time value of money. So are we going to account for the time value of money? Yes, if it is probable. But mostly we do not account for the time value of money for accounts receivable in the assets valuation. The reason is usually accounts receivable will be received in a short time. Okay, and also the amount is not material, so there's a trade-off between costs and benefits. So although there are some time value, but it is not material, so we do not account for the time value of money for most receivables. Okay. Yeah. So in practice, companies ignore the interest revenue. So we are keeping using the net realizable value to record or value accounts receivable. So it actually equals to accounts receivable, which is the gross amount subtract allowance for doubtful accounts. Okay, so difference is the net realizable value. Now let me introduce some journal entries which is associated with the accounts receivable recognition. So now let me introduce some journal entries which are relevant to accounts receivable recognition. So here we have the beginning balance of both accounts receivable and allowance for doubtful accounts. Okay, and allowance for doubtful accounts is the control account of receivables. So the balance of accounts receivable is debit 500. The allowance for doubtful accounts beginning balance is 25 credit. So the net accounts receivable is the difference. Is 500 subtract 25 is 475. Okay. Some firms report these three numbers. Some firms just report a net accounts receivable. Let's see. So this is an example which we report accounts receivable in the balance sheet. Okay. So this is the three numbers. The next one is just report the net realizable value of accounts receivable. Okay, based on the beginning balance of these two accounts, okay, let's see how the impact of each transaction on them. First is the credit sale. So this is a credit sale, $100. So we know it is sale, so revenue generated, right? Recognized. Also, credit sale recognize the accounts receivable, which represents the claims to the customer. Because here we debit accounts receivable, when we post to the T accounts, right? So we are going to debit $100. So now the balance of accounts receivable is $600 after this transaction. The next one is collect receivables, receive of the cash payments from customer. So we are going to write off the amount of cash received from the accounts receivable account. Okay, so the firm received $333 and also write write off 333 accounts receivable. And because this transaction, we credit accounts receivable, so we will see the credit posted to the accounts receivable account. And this will decrease the balance of accounts receivable to $267. So these are two journal entries we introduced in the prior chapters. The next one is recognize the bad debt expense. So we called it an adjustment for the estimate bad debt expense. Okay, so first, this is an adjustment. It implies this is a adjusting journal entry, which is made at the end of each accounting cycle. And there's no external transaction for this journal entry. Okay, so it is based on the estimate of accountants or the managers. Why we do this? Yeah, because nature of accounts receivable is what? Is an asset with the risk of default. Yeah. So whenever there is a credit sale, you provide credit to the customer, so there is a likelihood the customer will not make the payments, and this will become bad debt, right? But we can only learn the receivables become bad debt months or years later, right? But based on the accounting, the expense matching principle, when you generate revenue from credit sales, you also should match the potential bad debt expense, which exists for every firm. Okay? Yeah, some firms' collectability may be 99, some may be 99.5, some may be 80, right? So the collectability are different for different firms, but bad debt expense always exists for the firms provide credit to their customers, no matter what the reason for the default. So because credit sales we recognize, we also need to recognize the expense associated with the credit sale, which is bad debt expense, which is an operating expense. Okay, so the journal entry is we debit bad debt expense, which will be posted to the income statement as part of expense. And the next one is allowance for doubt of accounts, which is a control accounts of accounts receivable, right? So here we credit 15. This amount will update to the T account of allowance for doubt of account. Okay, so some of you may ask question, why we do not write off accounts receivable directly, but instead we credit allowance for doubt of accounts? The reason is this is estimate. So we post this $15 decrease in the net realizable value of accounts receivable to its control account rather than directly credit accounts receivable. So after this journal entry, we find the total allowance for doubt of accounts now is 40. Before we make this adjustment, the net realizable value of accounts receivable is 267, which is the gross amount of accounts receivable, subtract 25. So it's $242. But after this adjustment, the net realizable value will be 267 subtract 40 is 227 decrease. Okay, so if we directly credit accounts receivable, we get the same balance. Okay, so if we credit here 15, right, so the balance will be $252. Then 252 subtract 25 is still 227, right? But we don't do this. Yeah, we do this. Yeah, the reason is unless we have any solid evidence, we will not credit or write off the accounts receivable directly. What we do is we recognize this amount in the control account of accounts receivables. Let's take a look at next example. Write-off. So write-off means a firm received the solid evidence, okay, that the customer will not pay or the customer is not able to pay. So here it is evidence, right? So what we do is we debit the control accounts of allowance for doubtful accounts and the credit accounts receivable. Okay, so here we write off accounts receivable directly. So we debit allowance for doubtful accounts, which is the control account of accounts receivable. After this, right, so the balance of allowance for doubtful accounts will decrease to 30. And because this write-off accounts receivable will be credited $10, so the balance will be 257. Okay, what you find is 257 subtract 30, it is still 227. Yeah, the balance, the net realizable value of accounts receivable does not change after this write-off. And why? Because the expense, bad debt expense, has been recognized in adjustment. When we do not have evidence, we make changes to the control account. Unless we have the solid or quality information, we post to the account itself. So next slide is actually the same thing. Okay, so after all these transactions, this is the balance of accounts receivable after all the transactions.